Hello options traders, and welcome to everyone, and a very special welcome to all of the new members of the Options A to Z Facebook Club. And in this video, I'm going to cover the basics of how options are priced according to time. In other words, if you buy a 2-month option, will it cost twice as much as a 1-month option? And the answer is not what you'd expect, but you do need to know it to succeed with options. This video is actually in response and is the answer to a poll that I posted last week. And the question said, if a 1-month option costs $1, what would you expect a 4-month option to cost? And the answers were $1.50, $2, $4, and $6. I did have a number of people who got the answer correct, but a lot of you got it incorrect. Most people chose $4, which seems to be the most logical conclusion. If a 1-month option costs $1, then a 4-month option should cost 4 times as much. It's logical, but it's actually incorrect. The right answer is $2. To succeed with investing and with options, you have to have the proper perspective of a lot of different characteristics of the market, but especially how option prices behave. And if you don't, you're going to have misperceptions, and at a minimum, you'll have lackluster results, and at worst, they're going to be disasters. So you need to understand how options are priced. So let's take a look at why the correct answer actually seems to be wrong. Well, when it comes to option prices, they are priced proportional to volatility, not time. Volatility is this idea about fluctuations around a stock's average. So if you look at price line down here, let's say that this is the average price or the average trend of those prices. Well, volatility measures how much deviation there is from that trend. There's a mathematical way to do that. It's not important for us right now, but this calculation is really what drives an options price. So it turns out that options are actually proportional to volatility, not time. And specifically, they are proportional to the square root of time. And they follow what's called a square root pricing rule. So in other words, for options, it takes about 4 times as much time to double an option's price. That sounds more complicated than it is, so let me just show you where this pricing principle comes from. Let's say you have a 1-month option trading for $1. What is a 4-month option going to cost? And again, most people would think that it's going to be 4 times as much. But here's where the square root pricing rule comes in. Notice that we have, going from 1 month to 4 months, that we have 4 times the amount of time. That does not mean that the option's price is going to be inflated by a factor of 4. Instead, we have to take the square root of this number, and the square root of 4 is 2. Now we know that the option's price will be doubled. So if the 1-month option costs $1, the 4-month option is actually going to cost 2 times that, or $2. Notice that it costs twice as much money, not because there's twice as much time, but because there's 4 times as much time. When it comes to buying options, it's very much like buying things in bulk. Let's say that you could buy 1 can of Coke for $1, but you could buy this 6-pack for $3. It's absolutely incorrect to say that the 6-pack is more expensive. You shouldn't look at that and say it costs 3 times the amount of money. And that's because we haven't put things in common terms. We need to price these per can. For the single can, you're paying $1 per can. But for the 6-pack, you're paying 50 cents per can. So on the surface, the 6-pack might appear to be 3 times as much money, but it's really half as much. So if a 1-month option costs $1, and a 4-month option therefore should cost about $2, most novice traders are going to be tempted to buy the 1-month option because they think it's cheaper and that it's less risky. But when they do that, notice that if they wanted to trade that for 4 consecutive months, they would actually spend $4. A professional trader would take the 4-month option and spend 2, exactly half. So if you were tempted to buy the 1-month option for $1, notice that you ended up spending $4 instead of 2. And if you want to know something that's going to really damage your P&L, it's if you are spending twice as much money as you should. Now, the opposite problem happens when option traders become sellers. Let's say they enter into a covered call strategy. Now they say, I don't want to go for the cheap options. I want to sell the expensive ones. So I'm going to sell the 4-month option and collect $2. But notice that they are going to have to wait 4 full months to realize that $2. A professional trader would sell the 1-month option 4 times and would actually collect $4 instead of 2. So if you were tempted as an option seller here to sell that 4-month option for 2, you're only going to earn $2 instead of 4 over that same 4-month period. You're earning at half the rate. So the basic rule you want to know when you're starting out is that option buyers should buy longer dated options and option sellers should sell shorter dated options. Are there exceptions to these rules? Of course, but these are just the basics to help get you started. When you are buying options, stick to longer dated options. They are much cheaper per unit of time. To see this effect in the real world, let's take a look at Apple Computer, which was just trading recently here for $159.88, so just about $160. Down below here we have the options that are expiring in 5 days, and here's the at-the-money 160 strike. And right here the mark, which is the midpoint between the bid and the ask, is $1.69. If you buy that option, you are spending $1.69 to cover the next 5 days. On the other hand, what if we look at the January of 2019 expiration? That's 488 days from now. And we look at that same 160 strike. And right here at the mark, the price is $18.63, which might appear to be expensive, but you're not accounting per unit of time. Let's take a look at that. If you're spending $1.69 for 5 days worth of time, you're spending 33.8 cents per day. However, if you buy the $18.63 option for 488 days, you're spending just 3.8 cents per day. Why is there such a big discrepancy between prices? Because there's a very big discrepancy in time. Roughly speaking, you've got about 100 times the amount of time going from the 5-day option to the 488. Right? 100 times would be 500 days. Well, the square root of 100 is 10, so we know that that longer dated option should be about 10 times the amount of cost as the 5-day option. And if you take 10 times $1.69, you get roughly $17. And we see that that longer dated option is trading for $18.63. Of course, those numbers aren't going to work out perfectly because I didn't look at them in exact terms, but you're going to see that in the real world, this square root pricing relationship actually holds. Let's take a look at this in a little different way to see just how expensive this 5-day option is. If you were to trade short-term options over the next 488 days, how much would it cost you? Well, 488 divided by 5 is 97.6. And that means you would have to buy that 5-day option 97.6 times to cover that same 488-day period. And assuming our volatility levels stay about the same and that a 5-day option stays priced at about $1.69, that means you're going to spend $165 for 488 days. Now how cheap does $18.63 look? Successful investing doesn't require that you invest a lot of money. It does require that you invest that money efficiently. Buy longer dated options and you'll take the first step towards success. If you'd like to learn more about the art and science of options trading, please check out the Alpha Trader course at optionsato z.com.